Okay, Assalamualaikum warahmatullahi wabarakatuh. So today I continue with dividend signaling, right? The information contents of dividend theory. Okay, right. Basically, right, management will have the information about the firm's futures prospect, right, that the investors don't have that information. So this is called as the market imperfection or information asymmetry, right? Then the next question, how do investors analyze the firm's profitability then, if they don't have the information about the company's futures prospect? Okay, so the investors will refer to the dividend policy, right? And they think that dividend payout policy is a good indicator of the company's performance. Okay, where changes in dividend policy will be the source of information to them. Okay, about the firm's profitability. So this will affect the share price of the company. Okay, right. Generally, mm, the price of the stock will increase, okay, as the current dividend is increased, right, and vice versa. So this information contents of dividends theory, right, actually give a signal, right, to the investors. So there is a signaling effect, in other words, okay, whereby high dividend, right, signal and give a signal of the optimistic view where of the company, where the company has invested in many positive MPVs projects. Okay, while by reducing dividend, it shows or gives the signal of the company's performance, right, or imply a pessimistic view of the company's performance. Okay, maybe the investors, or normally the investors will assume that the company has no project, right, or the company has invested in a negative MPVs project, and that results in poor earning for that particular period. Okay, right. So this is the explanations about the um, information content. Okay, the theory of information content. Okay, it's also known as the signaling hypothesis. Like I said earlier, or as stated on the previous slide, so the dividend can give a signal to the investors about the company's performance. Okay, right. So this is the explanation. If the company pay high dividend, or if the company increase the dividend for that particular period, so it give a signal to the market the firm is expected to do well. Okay, this will result in the stock's price to increase. Okay, so conversely, right, the market infers a decrease in the cash flows from the dividend reductions, leading to fall in the stock's price. So that is why the dividend give the information, okay, to the shareholders or stocks holders. Okay, so this is the equation, mathematically, right, the equation below must hold if the firm is neither issuing nor repurchasing stock, right. If it is not paid out in dividends, it must be used in some expenditure, either involve a capital expenditure or stock repurchases. Okay, so dividends and stock repurchases are perfect substitute. Later we will go to the stock repurchases. Okay, so as a conclusion, the cash flow of the company basically equals or equivalent to the capital expenditure, the money spent or the cash spent on the capital expenditure plus cash dividend. Okay, right. Now we go to the stock repurchase. Okay, stock repurchase refers to the um, refers to the situation where the company distribute their cash through the stock repurchases to the existing shareholders. So in other words, instead of declaring the cash dividend, firms can rid themselves of excess cash, or firm can distribute the excess cash via or through buying shares of their own stock. Okay, so buying shares of their own stock from the existing shareholders is called as the stock repurchase. So recently, share repurchase has become an important way of distributing earnings to the shareholders. Okay, why is that? Because share repurchase is more flexible, right? And then it keeps the stock's price higher. Okay, and it can be as an investment of the firm. Okay, um, and then it gives the tax benefit. Okay, so these are the reasons or factors of why the share repurchase become popular nowadays in distributing the cash. Okay, so this is the example of the stock repurchases. Okay, let's say the firm consider to distribute 100,000 ringgit to its shareholders. So that the company have a choice. Okay, the company has a choice whether to distribute the 100,000 of cash here as cash dividend or as um, stock repurchases. Okay, right. Look at this one. So this is the example original information. Okay, given. So let's say cash is 150,000. Okay, and other assets value 850k, value of the firm then become 1 million ringgit. So let's assume there is no debt, and then the company rely on the equity issuance for the capital, and then firm's value must be 1 million ringgit as well. So that means equity also value 1 million ringgit, and then let's say the shares outstanding is 100,000 ringgit, 100,000 units. So because of the shares outstanding equals to 100,000 units, that means the share price will be 10 ringgit. How is it? 1 million ringgit of the equity value, you divide by the number of shares outstanding 100,000, so the share price currently is at 10 ringgit. So now let's say, right, the company decided to distribute this 100,000 ringgit to the shareholders, okay, via the stock repurchase. Okay, so if they distribute the 100,000 ringgit through the stock repurchase, the balance sheet will looks like this. Okay, after the stock repurchase, definitely company distribute 100,000 cash just now, so it becomes 150, becomes 50 ringgit now. Another assets will remain 850. So that means the value of the firm now becomes 900,000 ringgit, right? Existingly, the value of the firm is 1 million ringgit, right? So now it becomes 900,000 ringgit because 100,000 ringgit has been distributed by paying the 100,000 ringgit to the existing shareholders, okay, for stock repurchase. Okay, that means the value of the firm becomes 900,000. Okay, right. Then how much the value of equity now? Okay, so the value of equity now becomes 900,000 because debt U is 0. So 0 plus debt plus equity must equivalent to 900,000. So that's why equity becomes 900,000 ringgit. So now what happened to the share price of the company? And then what happened to the shares outstanding now? Okay, the meaning of shares outstanding is the number of shares issued by the company. So number of shares issued now become lower. Why is that? Because 10,000 shares has been repurchased by the company, right, at the price of 10 ringgit. So that's why the equity value now becomes what? 900,000 ringgit, which is 90,000 ringgit shares outstanding left, multiplied by the share price of 10 ringgit. Okay, alright, so the share price remain 10 ringgit if the stocks repurchase undertaken by this company in distributing the 100,000 ringgit to the shareholders. So what happen if the company do another choice, okay, or make another choice, which is what? Distribute the 100,000 ringgit as a cash dividend. So how does the balance sheet looks like? So after 1 ringgit per share cash dividend, okay, so cash again become 50,000 ringgit because cash has been distributed by 100,000 and the rest remains, so the value of the firm now becomes 900,000. However, the number of shares outstanding is still the same, right? The number of shares issued, alright, or still remain with the existing shareholders is 100,000 ringgit. Okay, what happened to the share price then after the cash dividend? So the firm's value here must be equal balance, debit and credit side. So 900,000 ringgit divided by 100,000 shares, that is the number of shares outstanding. Okay, so the share price becomes 9 ringgit. So that is the difference. Okay, implication in terms of the implications of what? Cash dividend and stock repurchase. Okay, so you can see the difference between these two. Okay, so now we want to see the stock repurchase benefits and also drawbacks. Okay, the benefits of the stock repurchase is first, company used for surplus cash which may be a debt asset. Okay, and then increase in earning per share through the reduction in number of shares in issue. Right, because the number of shares issued now reduced, that means the earning per share will be higher, denominator become smaller. Okay, stock repurchase may allow debt to be substituted for equity, right? This will be raising the gearing. Okay, and then readjustment of the company's equity based to more appropriate level for the company whose business is in decline. Okay, so this is good for the company who facing the problems of a decline profit or decline cash flow. Okay, so possibly preventing repurchase can prevent the takeover. Okay, or enable the quoted company to withdraw from the stock market. Okay, the weaknesses of the stock repurchase is that it can be hard to arrive at the price that will be fair to any shareholders who are not selling shares to the company. There may be some investors disagree with the price offered by the company when the company want to do the stock repurchase. Okay, so it's not easy to determine the fair price to the shareholders. Stock repurchase can be seen as an admission that the company cannot make better use of the funds to the shareholders. Okay, and another one is some shareholders may be suffered from being taxed on the capital gain because some country has to pay higher tax on capital gain following the purchase of their shares rather than receiving dividend income. Okay, so this is about stock repurchase. And then the next one, scrip dividend or scrip issue, which is also known as the stock's dividend. So instead of paying dividend and instead of doing the stock repurchase, the company also can do or distribute the dividend in terms of or in form of stock. Okay, right. So this is also known as the stock's dividend or bonus issue. Okay, when the company's management prefer to retain cash flow but consider that they must pay certain amount of dividend to make the shareholders happy, so they might offer the equity shareholders to the choice of the cash dividend or a scrip dividend or a stock dividend. Okay, a scrip dividend is a dividend paid by the new issues of additional company shares to existing shareholders rather than by cash as dividend for free. So that means the company distribute in the form of stocks, distribute dividends in the form of stocks. So this will increase the implications of the scrip dividend. It will increase the number of shares outstanding and it will reduce the value of each shares. Okay, once the number of shares increase, and then the firm's value will divide by the number of shares. Okay, and the number of shares become higher, the denominator become bigger, so that means the stock's price become lower. Okay, so these are the benefits of the scrip dividends, okay, and the drawbacks of scrip dividends. Right, I think you can read here on your own, right, and So that's all for the dividend topic. Okay.